Good morning, everyone. Thanks for joining. Okay, first question is, can Boon Tee share his portfolio and plan? Thanks. This is my portfolio right now. It's the same content. So in terms of the names, I think because I have not been doing much in the past few months, even this entire year also, I'm not doing much. So the portfolio is quite stable. The big names are the same names. Sometimes they swap places because of the market fluctuations. But recently, even though Nvidia dropped to 410, but still top positions. I guess that's also because Amazon, Microsoft, Apple, all these names also dropped. So in terms of the positions, uh, here it is. In terms of the market value, I think it has been at 500K for some time, and then just I think 2 days ago after the Fed announcement, um, I think stock prices also dropped. So here you see a small dip here. Hopefully this is not a big crash coming. But anyway, because I'm not doing that much and saving up cash, I'm actually hoping for some drawdown so that I mean, it's more comfortable to buy when the prices are, a bit lower. So I think that's my position at the moment. I'm not sure. Let's say for those who are listening, if you have more questions, you can just type into Slido, or you can just type in the message. I think I'll try to be more specific. But in terms of the plan, I think the other questions asked about T-bill and so on, I think I will comment on that later. So that's on the first questions. Anyone have any questions, or you want to ask more specific in terms of my portfolio here? Okay, if not, let's move on. Is there any hope for value investing like dimensional, etc., or will it be mega caps all the way from now on? Okay, just now before started, I was looking for this chart. I've seen this before. I think it's quite useful. This is from longtermtrends.net now. I actually haven't really read into very details how they construct all these indexes, but to put it simply, right, it is just a comparison of the return performance of growth versus value. But traditionally, what is growth, right? I think usually they are using some sort of like revenue growth as a proxy. Whereas for value, usually they are using like price over earnings, price over book, this kind of measures, and they are comparing these two different factors, which one are performing from year to year. So you can see that I mean from period between, let's say, 1994 until 2000, where this is during the dot-com bubble, right? So you can see that growth names they outperforms. Then subsequently from dot-com until, let's say, 2007, I think growth underperformed. So value factor really performed well during this period. And then from 2007 until 2021, you can see that it's back to growth stocks again that is outperforming. And then after that, during 2022 drawdown, right? I think growth stocks, all these like tech name, big tech, all suffer quite a big loss. And then from early this year until now, I think growth came back a little bit now. So currently it is at this level. The ratio is 1.3. But the question is like, if you compare growth versus value factors, right? Which one is going to outperform or not? Actually, it's quite hard to tell in terms of which one will outperform, because you see this chart, right? From 1978 until now, you see it goes up and down and up and down. But over the long period of time, you don't see that like growth just keep going up and up for decades, right? It's not like that. It can outperform for many, many years. Like let's say from here to here, we're talking about like 7, 8 years, and then underperform also about like 7 years, and then from 2007 until now, you can call it like what, 16 years. Growth has been outperforming for quite a number of years. Whether it will come back or not, or whether you see this kind of like skyrocket or not, this one hard to tell, right? But just I think the key takeaway is that they come in cycle. So certain period is favoring growth, certain period is favoring value. But it's the difficult part is that which one should you choose, and which one should you rotate to, right? So that one I would say is very difficult. But I would just say that it comes back to your own preference, right? Because if you are growth investors, like for example, you prefer to buy into companies that are riding on certain trends, certain waves, they are doing well. You like companies like Tesla, right? So their revenue is like 40% growth, 50%. You favoring this type of companies, then you just go all the way, just focus on growth, right? If you are not willing to pay high valuations, you prefer to pick names that are like lower PE, but you don't want to buy it buy expensive stocks, then you can just focusing on values. I think either of these can make money, but if you switch back and forth between these two, right, then you need to be very sure that you can time the cycle well, which is, I would say, is much harder than compared to like just focusing on either growth or value alone. So I think that's the key takeaway from this chart here. For myself, I think my current style is more steered towards growth. Value, I don't think so. Especially those companies that, they are, like 10 PE, 8 PE, but you don't see much like they're not riding on any trend. And then sometimes you even see that companies is like suffering or they are being disrupted. So I'm not favoring this type of companies. I'm more towards growth companies. But I'm not saying that growth will outperform value for long period of time or over the coming years. That's not I'm saying. You can still make money from either of these two.
You have to look at the different, whatever you do, you have to look. There's always a way to make money. It's just that whether value or growth or what is in the end, it still has to be a company that does well over time. That's the thing. Because you can have the ideal value company, but if it doesn't do well over time, your gains are still limited. Same with growth. It doesn't do well over time, even if its growth is good now, then its gains are limited.
Yep. Yeah, I think that's right. I think, and then there's some differences here because, for example, if you are buying into growth stocks, what is being priced into the share price is the future expected growth. Say, for example, Nvidia, if you think that they can grow at, let's say, 40% over the next 5 years, right? But the market think that they can grow at 100% over the next 5 years. Market is overpricing that, right? That means if it doesn't meet the 100% expectations, then it will tend to underperform. So the key indicators for growth stocks is what is the growth that they are going to generate over the next few years. Whereas for value, you don't, because the companies, like, usually they don't have much growth one. So for value stocks, but they need to sustain their earnings. Because let's say if you buy a stocks that has a PE of, let's say, 5, right? But let's say after 1 year, the earnings drop by 50%, right? Then the PE of 5 become PE of 10. Then it drop another 50%, the PE of 10 become PE of 20. So it is possible that a value stocks, as the earnings keep dropping, the stocks looks more expensive. And if the stocks looks more expensive, there are existing investor who are looking to buy or holding cheap stocks, right? They will just sell away. That's why the stock will underperform. So I would say that for PE, like low PE stocks, right? If you go into value stocks, right, the number one priority is you need to buy into companies that at least have a sustainable earnings. The earnings doesn't need to grow a lot, but at least they need to be able to maintain. Because if a company is going down to zero, right, in terms of their fundamentals, right, it is hard to generate a good returns unless it's really, really like, they are very cheap, like the valuation is lower than the cash in their balance sheets, right? Then that's another story. But usually I think this so-called value trap, right, is something that you need to pay attention to if you focus on value companies. But I think back to these companies, right, because we are talking about like dimensional, right? So these are fund houses that focus on value factors, right, or growth factors. And you need to understand like what's the methodology that they are using. It might not be the same. For example, like value factor is not the same as those who are doing value investings. Whereas for growth investing or growth factors, right? I think growth is relatively simpler, but still you need to understand how they come up with their stock selections, and they are diversified funds, right? So if you bought into their philosophy, like all these growth or value factors that they discover will outperform the general market, then it's okay to invest into these names, right? If not, right, I would say just keep it simple and just buy broad-based index, right? I think that is a lot more simpler. Like you don't need to understand all these details about how they construct the portfolio, how they like rebalance and so on. So I think there's if even this is like a diversified funds, you still need to have some idea on how they construct. If not, let's say if you underperform the broad-based market and you just like scratching your head and ask like why. So you better do the study beforehand to understand. Usually you only buy into funds if you agree with their philosophy, their methodologies. So that's something worth to point out also. Okay, any other questions? If not, we move on.
For value growth, whichever the case it is, right? The other important thing, of course, is to look at the debt. What is their like debt ratios, like their current ratio and their long-term debt ratio and things like that. Because if you just look at value or growth, you don't look at debt, you won't know what's.
Yep, I think that's worth to point out also. It's just that I think for in this case, right, dimensional, I think they are fun. So debt level, I guess if as long as it's diversified, right, the debt level, I think it just reflect the broad market debt level. So but you are talking about like individual stocks, right? So I get that. If you have to buy one value US, China, and Singapore stocks with a 5-year horizon to maximize returns, stock appreciation, and dividend, what would you buy in each market today? I'm not sure why it's not specific, like it's not just a geography specific, like US, China, and SG. There's this one word here, value here. So talking about value stock in US, China, and Singapore stocks. I guess that's the question is asking. Yeah, I'll just see around Y6. Do you have any names that pop to your mind, like you'll be interested to buy? Because we're talking about value here, right? It's very specific. Or you can name something that's not value also works, or value in your own definitions.
I think Apple is a value stock now.
Mm-hmm.
Yeah, I think Apple is a value stock now. But if not, then as what I do is I prefer to buy the oil stocks, because the
Mm-hmm.
oil stocks actually give pretty good dividends and their PE ratios are low, and I don't think they are close to being disrupted. So
Mm.
that's my opinion, because from what I see is that's the case,
Mm. Will you buy into like China oil companies? Have you looked at them before?
The thing is that I actually I don't mind investing in China. It's just that my main issue with the investment in China is that I'm still not very familiar with how they calculate their. I mean the different accounting structures is it it, it actually like matters, because if they are not transparent on things, and then they have like different their rules can change, that it's not the Western way of doing things, right? Then
Mm.
the it is not as transparent, in terms of like how how the how the how they react to different events. It's much harder for me to buy into that, because of, I can't, I have limited information on in this area. So that's the issue that I have. I mean, if there is like, if I actually find someone who is understands the Chinese market well, and also like knows like the Chinese accounting rules and how they actually respond to events and things, then yes, I might consider going for China stocks. But as it stands right now, the way I look at it is that so long as China is importing Western goods, I have exposure indirectly when I buy the Western stocks already. So
Mm, mm, mm.
there's no need for me to actually to go and specifically buy Chinese stocks, right?
Yep.
Because if if they are importing those Western goods and their economy does well, their people have a perception that the certain Western goods are what they will import more, then then I have the indirect exposure already. I don't need like double the exposure. And not only that, if I actually buy like some, let's say product like electric vehicles, so if I actually, let's say if I'm invested in like Tesla or whichever in US that do electric vehicles,
Mm-hmm.
and they are doing well is because their EVs are already, firstly there's the American market, then there's the European market, and then there's Chinese market. So these are the three big ones. I mean, there are other small ones, but when they do well, because they are already a global company, so if let's say China has like a economy issue, then their stocks will also drop based on revenue drop from the China side. If I buy into like Chinese EV, number one, I'm already cannibalizing against the in this area, that cannibalizing in terms of like the allocation wise, I'll be double allocating already, right? So it becomes like it's a hedge. So it's either I double allocate or it becomes like a hedge. I cannot allocate too much. So that's the issue with that. So unless we are talking about something like suddenly China says that we are going to ban all the Western goods in this particular industry or sector or whichever the case, and then this industry, in fact, we are doing so well and we are going to go global, and we are okay with US banning our goods. We are going to sell to Europe, and we know Europe will buy, and we are going to sell to the other countries, and we know those other countries will buy because our goods are just purely superior. Then yes, that is a compelling case to actually go into that sector for that particular good. I mean, if it's dominating until that kind of level it's just like if you talk about like it's just like you talk about semiconductors and all these chips right now is mainly because of Western side is dominating until that level that they are able to do tariffs and restrictions, and you can kind of see that China is not retaliating in this area, right? Because they still need it, and they don't have any goods that they can. I mean, they're trying to build right now, and maybe they'll succeed, maybe they'll not. But it's not a matter of a 1-2 year thing. It's at least 2 years or more before it brings out anything. So that's why you can see that that's the area that that the exposure wise there in terms of like what how we want to allocate differently yeah.
Sorry, some interaction. My kids in in the room. Okay, thanks a lot, YCX for the comment. Yeah, I got what you mean. It's more like, okay, if you are specifically want to look for oil stocks, I think US serve the purpose. But let's say if there's certain sector or category that you see there's something that's different on China, whether it's on the market side or whether they have some, like promising products, then it makes sense to get into those areas. So you're not staying away from China. It's just that specifically for oil, US is good enough. Okay. I have one more question, because you mentioned about Singapore stocks here. So do you want to comment on Singapore stocks? Is there any like one or two companies that you want to mention here?
Pretty much Singapore stocks are more, I mean, to be honest, Singapore stocks are pretty much, I would say they are pretty weak in terms weak, and also a lot of it is resting on the property prices as well. Like if you look at all the Singapore stocks, they have some degree of property exposure. So it is very much some of their stocks are just propped up by the land or the property that they own. So that is one issue that I find, because if we are just going by property itself, then it's a different class of asset really. I don't really like to mix, like say, property together with a business running that is more product oriented because if I want to consider property, then I have to consider the property market as a whole. That means I have options like buying residential personally and owning a stake in that way. I have options like buying commercial, or I have other options like buying REITs, but I don't really like REITs, so that's besides the point. Then there's the other option of like buying Singapore stocks that have exposure to this real estate. That's the other thing. But then with real estate, because it's a lease structure, right? So there also comes into particular some issues because when we are having a lease structure, there needs to be extra scrutiny into how the lease is structured, because lease can be done in many different ways, right? Whereby some companies, I think I mentioned this before, which is that they might have, let's say a company is trying to build, I mentioned it with the donuts, which is that a company is trying to, let's say a company sells donuts. So in order to sell donuts, they maybe need a central factory to produce the donuts, and then every day they deliver the donuts to the different donut outlets to sell the donuts. So that's like the business model. So in order to have this factory, they have a few options. First option, maybe this donut factory needs like very specialized equipment. So they would most definitely have to build the factory, or they have to lease the factory, or they might build, and then after they build ready, then they lease it, they sell it away, and then they lease it back to themselves. There's this kind of structures that are in when it comes to properties. So the so the long story short over here is that because of how property is structured, right, it's very easy to actually change the ratios, the financial ratios, because you can they can easily just build a factory and then sell off the factory and then lease back to themselves, and then suddenly you can see that the ROCE is suddenly very high already, because they just got rid of like a huge chunk of their capital that is tied to the land, right, tied to the property, and then they lease it back, it becomes the operating cost is higher, but then the capital employed is way lower in that regard. Then suddenly they have like you see their balance sheet, you see their financials suddenly look very good. That could be one way lah. So for Singapore properties, for Singapore stocks, there is more. I'm not saying that US stocks don't have this exposure. Any company that runs this kind of manufacturing thing have this. But for Singapore, because Singapore stocks are not really like global, right? So there is a higher exposure to localized property prices in this regard. That is my concern. And to be honest, there's a lot of things that can make money and invest in. It's just that it's about whether one has the time to read up and has the interest to read up, and also and do the research and be familiar, and also have the support, the investment support group. That means people whom are already in the know of this area, right, to support this kind of investment. So those are the main concerns when it comes to investing in this kind of Singapore stocks. Then that's what I have to say.
Yeah. Thanks a lot for that. Okay, my comment on this, I think firstly, I want to say that this question is asking for stuff that I haven't been focusing a lot on. For example, like value, talking about China, Singapore stocks. But on the US one, I agree with YCX. I think Apple, as of now, is still very, like, you can call it value stocks, given that in terms of, like, free cash flow generations, they are very good. I think that's I'll pick Apple as well. For China and Singapore, I think that's a bit difficult. For example, when talk about China, I'll be thinking about Alibaba, for example, right? If you look at their earnings, if you look at their core earnings, free cash flow, all those, at least on the income statements, I'll say everything looks good. It's just that when I look at what they plan to do with their management, right? For example, now they changed the new CEO, and then they say they want to break up the companies, and then they say they want to like IPO, then they say not going to IPO, and then I think one of the entity they say they want to IPO. So I don't know like what they are trying to do there. And again, for China, I think competition is still a risk that I'm not that comfortable. For example, like JD, they just dropped their like all this merchant fee and then try to compete for market shares, right? I think in China, when they do business, as they want to grab more market shares, right, they don't really focus on margin. They just go all out and just get the market shares. So that's also the part that I'm not that comfortable. So even though you look at their PE is low, I'm not, like, I don't have a high confidence that they're going to sustain. So that one to me is a value stock, but it may not be something that I would like to pick because of the risk that I just mentioned. And of course, for China, even if you can, pick the companies that can outperform, even so, but overall macroeconomy, I think for China will still be quite challenging, at least over the short term. Over longer term, still need to monitor, so can't really bet on that. Okay. For Singapore, I would say I agree a lot with what YCX just mentioned about like the companies here, they are relatively weaker and they are not as international. Their business are usually just confined within Singapore. But if you want to name a few stocks, right, I would just say banks that are doing well like DBS, OCBC. Given that interest rate is high, so this one they definitely benefits from the high interest rate. I think REITs also could be good, but it's on the opposite. They are suffering because interest rate is high, so the one you might want to pay attention to lah. Yeah, I'll just pause here. I saw that typical Singaporean, you want to say something?
Yeah, I think because there are two separate actually elements in this particular question, because I actually don't know whether the person is talking about US, China, and Singapore incorporated stocks, or US, China, SG listed on the respective countries' market stocks, because those are actually separate questions. I mean, for example, Grab or SE, are they Singapore stocks or are they US stocks? Because they are listed on the US market. Is the person asking about US listed, or is he asking about Singapore incorporated?
That's the thing about Slido, right? So we can't ask, like, well, I don't even know who asked these questions, right? But you can define it yourself and give your comment.
because the two things the three items talking about, you actually combine together, you see, because we talk about DBS and REITs, that's Singapore listed stocks. But the Chinese stocks, I guess you're talking about Baba and all that, they're actually ADRs in US market. For myself, I would never invest into the Shanghai index or even the Hong Kong one, because there's so much risk involved with the corporate governance as well as capitalization within the markets itself that make it a very unattractive proposition to invest into the market itself, not the individual companies that are listed on US. So if I was to look at it from that viewpoint, just on incorporation but listed onto Nasdaq or NYSE, the guy is just asking if from these respective countries, which is there any company in Nasdaq or NYSE that is based in US or based in China or based in Singapore that is a value that is undervalued, right? That's basically his question.
Yep.
So I mean, I think this question was asked, but I guess you guys didn't focus on Grab, SE, and I guess the newest one is Oh My Home that's listed on some sort of secondary market in Nasdaq. And Singapore, I don't see there's any because they're all not generating FCF. Am I correct? Is any of the companies actually generating FCF in Singapore?
You are talking about like what I don't understand why you talk about like all this C, right? Because Singapore there are still many companies, right? Some may pick Keppel, right? Or you can pick DBS or
we're not talking about Singapore market listing, right? We're talking about Singapore.
I don't think it's about listing. I think it's about like companies, like US companies, US companies. Singapore stocks means Singapore companies that is at least have business in Singapore. So listing is one thing, right? Yeah.
So is the person talking about investing into the Singapore market, as in DBS, all these companies, or is he talking about investing into Singapore companies that are listed?
No. I don't think so. I don't think so. I don't think you need to restrict to those listed on US, because I think most of us are based in Singapore. Definitely you can open brokerage and invest in Singapore companies.
The issue about the Singapore market is low capitalization and concentration of banks and property market, right? Like there's also very poor corporate governance. I mean, you know all the stories about how family members actually own more than 50% of the stock holding. So they actually have an internal vested interest in management and shareholders pushing through things that will oppress minority shareholders. So unless you're investing to DBS or property, banks or property, all these smaller companies that have low capitalization, usually it's family controlling it. and you basically can be oppressed quite easily. So I would never invest into a non-property, non-bank in Singapore.
Yeah, but those are the characteristic of the specific markets, right? I think we're not discussing the macro here. We're asking like, okay, for each of these geography, right? Is there like one company that you would like to pick that you think good in terms of risk return? You don't need to judge the 500 companies, right? At least just one that you think is good.
It's just either REITs or banks here. I haven't investigated very much because I think all the value is in the US market, to be absolutely frank. Because capitalization itself is very important in investing on market. How much people are willing to put into the market itself determines the liquidity and also gives a more efficient price discovery mechanism. Right now in Singapore itself, I don't think that there's enough capitalization to get that going. So even in the Chinese market, in the Singapore listed exchange, I don't even consider it. Yeah.
Okay, so no pick for China as well.
No pick for China. I mean,
okay.
we're talking about Shanghai index, right? The Shanghai market, right?
Any company.
Yeah, I know. We're not talking about ADRs in Nasdaq.
I think included, everything included, as long as the company is based in China, doing business in China. Is there one business that you would like to invest?
I give you an example. I work for a company right now. Okay, I work for a company right now that has business in China. About 35% of the revenue comes either from supplies or selling to the common market in China. Okay, it is a US incorporated company. Okay, in Connecticut. Okay, listed on New York Stock Exchange. Okay, but that revenue itself is a lot of it is Chinese market. They have companies that they own that actually are incorporated in China, with Chinese directors and all that. Okay, in a global business with revenues 35% from China, 65% from rest of the world, US incorporated. Those are the companies that are listed in New York Stock Exchange. China market goes down, that portion of their revenue goes down. So they are globally diversified, US incorporated. Now, a Chinese company, I know a couple, have interests also in the US. They also have revenue in US. So the only difference between those two companies is the share of revenue that comes from that particular country and the incorporation element. Who's the corporate governance, how the corporate governance works. If I was to choose between a company that has a structure that is answerable to the US government and one that's answerable to the Chinese government, I would say that there's less risk in a company that's answerable to the US government due to the politics of that nation. Because then I'll look at their business structure, how much of the revenue comes from China, how much of the revenue comes from rest of the world. China right now is down, but it will recover. I believe it will recover. But the element of incorporation is the important element. Who do they answer to? How do they pay tax? Is the tax in a way very, very transparent and overboard and fair? I don't think the Chinese system is fair to capitalists. They may be fair to the population at large. That's how I put it. So that's the reason why I don't have any exposure except for a tiny amount in China equities.
Okay. Yeah. Okay, then what about US? Like one value US. Is there a pick from you?
I picked Amazon, right? Amazon and Microsoft.
Okay. Have you been following Amazon developments or I mean,
it's a long-term thing, right? I mean, they will not go down. They will not I mean, it's but I do pick Amazon and Microsoft, not Apple.
Okay.
Or value. I mean, that one is a completely different topic. I mean, we have gone through this before.
Yep. Okay. Thanks a lot for your comment. All right. Any other comments?
I think there's a value stock that would be valuable, but this is purely based on crises, because for time and again there's only like pretty much one company that the Singapore government would save, which is SIA. So if there is ever a crisis and SIA drops a lot and is having like some kind of crisis, so long as Singapore wants to remain a viable country and the political side wants to have a national airline, then SIA is kind of like a good is a good buy lah when it's down for due to some kind of crisis. That's for sure. But as to when this kind of crisis will come and whether one has the capital available to buy when the crisis comes, that's another thing altogether.
I actually disagree on this there, because the companies will be around doesn't mean that you will have a good return for as a shareholder, because whenever crisis down, right, there's some sort of crisis and government will just say, okay, we are okay to, like for the company to do right issuance, we pump in capital. You may not be willing to pump in capital because we as a shareholder, we think of like how to make money. But when government do things, right, they just want to make sure the company survive, right? They may, pump in capital that doesn't make any sense, so you might get dilution, like a lot of dilutions if you don't like follow the government to pump in together. So there might issues like
yeah,
this.
that's what I meant. That means only allocate when there's a crisis, like, and the government showed that they are committed to supporting it, then that's the point to go in, which is kind of like what we see in the Chinese case right now. But the thing is that the Chinese government is very inconsistent, and they say one thing and then the next week they do another. So that's the issue. Whereas compared to like the Singapore government, it's kind of more they say it and they do it immediately. Yeah.
What concern about is that you can save a company, but you can screw a shareholder. That happens so often. So just because, let's say SIA went down about 60% in COVID period, and of course there's a lot of confidence that it will go back up again. But if the government wanted to screw the shareholders and didn't, and even they save SIA, they can very well nationalize it and basically buy up all our shares for the lowest price. That is entirely possible.
Yep. Okay. I think good discussion on these questions. Actually, the next questions I'm also quite interested to hear two of your opinions. Typical Singaporean and YCX. 2021, investor Fomo-ing into growth stocks like C Limited, Tesla, etc., plus crypto, time to risk off. Then now 2022, 2023, Fomo-ing into T-bills and government bonds, time to risk on. So I think this question is mostly asking about like, should we, like go against the cycle? Because whenever everyone is going into growth stocks, you should actually just sell out when the price is high. And then now everyone is like, okay, let's go for T-bill, let's buy government bonds. Is that really like we should go against this trend again? Probably, like because interest rate will come down, stock will rally. So what's your stand with regards on this? Sorry,
no stance. I think
no stand.
Just everything is not like just reverse. But then you see all those altcoins all go down, then also reverse into zero. I say.
Okay, typical Singaporean.
Yeah. I think this is quite relevant to me, right? Because I'm the one that bought a lot of fixed income this year. I bought a lot of fixed income this year, but it's not because of FOMO, I think. I hope so. It's mainly because of, I guess, strategy to protect existing assets. Because the equities was quite bad in December 2022. Then, of course, by doing so, I missed out on all the gains. So only my equity portfolio grew by a lot. But of course, the bond portfolio did okay lah, because it's fixed income. So now I'm really in the bind whether or not to allocate to equities a bit more from the fixed income. I actually have no idea. I'm just thinking about it right now before the end of the year. Yeah. So if you go to the other channel, the FIR channel, I did ask question: should I reallocate again or convert everything to fixed income?
Yeah, what's your rough allocations between equities and fixed income right now?
Well, right now my equity is about only 10%.
Huh? Oh, equity only 10%. Okay.
Yeah.
All right.
Almost everything is fixed income. Yeah.
Okay. All right. I think this is this is a good great questions. Yeah, talking about cycles, but I do see myself, right? Like for example, I mentioned about like just this year not doing much, meaning that I'm not buying a lot of stocks or ETF. I actually like, like just building the T-bill ladder, go and buy some, like basically T-bill money market funds, these kind of things. So I do see myself like, okay, am I like follow the trend too much? Just just maybe now is the best time to buy stocks, right? Before it rally another 50%, right? It could be, right? Uh, Given that now T-bill is high, we all just park into T-bill. Does it make sense or not? So I've been asking myself this question too. But for me personally, because I started out, like practically 100% stocks, right? Aside from CPF, right? I don't have cash one. If you ask me like 1 year ago. So I just started to build up these cash positions around early this year. Okay. So that's why I'm still okay to, like accumulate a little bit more into T-bills and money market funds. Because even so, it's still like very small allocations. So I'm fine to just take advantage on the upcoming auction or money market funds. But I do see the point that, okay, if everyone, or by everyone, I mean most people are buying T-bills, they are not buying stocks, right? What it means is that, okay, stocks should be, like attractive currently. But the thing is, if you look at the valuations, right, it doesn't seem so. The valuation still seems a bit high, especially if you look at S&P 500. Of course, if you look at China and you look at Singapore stocks, of course they look cheap. The entire emerging market looks cheap. So if you are into all these emerging market, Singapore, China, I would say yes. If you anyway want to buy, you should buy now. They really looks cheap now, but not the case for US and not the case for especially US tech, because my portfolio is mostly steered towards US tech, US stocks, right? To me, they are quite expensive. So that's why I'm okay to buy more T-bills at the moment. So that's my stand on these questions. Okay.
I think it's, for me, it's event driven. If I think that there's going to be a recession coming up, then it's a risk off. That means you buy T-bills, the T-bills will not drop one. The T-bills in a risk off the kind of thinking is that, let's say, I don't know, some crisis happens like tsunami hit Florida and half of Florida is gone, something like that. Okay, if something like that happens and then let's say US economy is affected, then maybe let's say just so happens that a lot of factories are located in Florida or whatever things, and then in this kind of area, and let's say the event is not localized, it's global, then the US economy will, of course, if they are really going to see that just because of this one event, their GDP is going to go negative, right? Then straight away, the interest rates, there's going to be cash shortage. People will need, there's a shortage of liquidity, shortage of funds, because suddenly a lot of jobs are lost and people start saving up their money in the event that they lose their jobs, and the kind of cycle. So in this kind of situation, then what will happen is that the fiscal side will start to spend more to try to build up these areas, and then the monetary side, they might actually just reduce the rates. And the moment the rates are reduced, of course, the T-bills that you buy will all go up. They straight away go up. Is the fastest way to go up. But as for stocks, because of the initial event, right, suddenly all those companies that are affected and their downstream and upstream are all affected, so they will all drop. But T-bills will not drop at all. In fact, they will maintain there because they have a value that is not that will not change with the event as much. The correlation with event is not as much, because the correlation is more with the monetary policy and fiscal policy. So once that happens, and people will start to think that the fiscal side and the monetary side, the rates will go down. And the moment rates go down, bonds will shoot up. And then bonds shoot up means that more people have this amount of money, liquidity around to play with, which means that then there will be the point whereby people will go back into stocks if they think that the economy will recover from this stimulus that's being pumped into to deal with a crisis. So that is the kind of event cycle that I look at in terms of like whether to buy into T-bills or not. So of course, let's say the other factors that people think about is like where their age, their portfolio, and like sometimes people buy T-bills because it's like they want a certain amount of income because it's stable income that they can just spend in that way. So some people buy into that. But if you're talking about just pure investment kind of idea, right? When you buy into T-bills, you are betting on that there might be some kind of event that will lead to a recession that immediate reaction will cause stocks to drop harder than T-bills would drop, and then T-bills would then go up later in the event due to the adjusting policy by the government. That's the idea when I look at T-bills in from a investment perspective.
Yeah, thanks for that comment. I think hold on a second. I think this you brought out a good point about like okay, which whether we should buy into equities or not, and also depends on economics, right? So I think this chart is a good one. I think to just break down the economics, I think there are two angles to look at that. I think the first one, the more important one currently is the inflations, whether inflation will come down or not, right? And then secondly is the growth, which talk about the GDP that you just mentioned. So I think if you say whether currently is good time to buy equities or not, I think two things we want to see if you really bet big into equities, right? First, inflation needs to come down, so it needs to be low inflation. Secondly, you want to see the growth sustain. It doesn't need to like pick up 2x from here, but at least growth don't slow down. We don't want to see like soft landing, hard landing. If there's no landing and inflation come down, then equities will just rocket to the moon, right? So I think this is something that we are betting on as a equity investors. But let's say if the inflation doesn't come down, right? Like if it stay high, right? Even if you buy into bonds, right, you are not going to get a good returns, because as the inflation stay high, interest rate will keep on going higher. And if you buy into especially those long dated bonds, for example, like all these TLT ETF, right? So you will still suffer a huge capital loss for bonds. But let's say if there's a scenario where inflation does come down, but together growth also come down, meaning like recession scenario, right? So growth drop, inflation drop, and then interest rate follow inflation drop. In that scenario, bonds is the best investment, because now like you are not suffering all this drop in equities as the growth slow down. Then your bonds will enjoy capital gain, because maybe the long-term rates also come down, right? As the Fed cut in interest rate. So I think it's really like there's like 2x2 quadrant here. Very, very hard to guess where are we heading. But it seems that as of now, growth still able to sustain. So we are more towards the right-hand side at current moment. But inflation stay higher compared to expected. So actually, we are somewhere around middle area here. So whether we are going into like low inflation, high growth, meaning going into equities, or going into bonds, whether they slow down or not, it's hard to say, right? So you need to have a balanced allocations between bond and equities, just to make sure that your investment doesn't suffer a lot because of like different environment that we are in. So I think this is something worth to point out.
The other thing that is over there is that this chart is important in that you don't buy into it when the event happened. It's actually you buy before the event happened. Because if you buy into it when the event happened, then it's the reverse. You're not getting as much gains, and you are actually dying because of this. And then also the other thing is that top left quadrant I don't agree with, because top left quadrant is kind of US centric in the sense that actually if you have high inflation and low growth, the answer to that is actually everything will drop and exit that economy. It's not even buy tips, it's just exit the economy already. Because you have low growth and high inflation, there's there's no hope of saving it already. Yeah.
But you still need to park somewhere, right? It'll be in the form of tips because as the inflation get higher, the tips pay more pay more coupons
The
to
thing
you.
is that in that regard, the inflation will actually heavily outscale, and then the tips will not catch up at all. In practice, that's what will happen, in my opinion. But what's actually is going to happen in that case is actually, instead of tips there, it will be to exit economy and allocate into other economies where there are more safeguards against like inflation in that regard. That's my, so I would actually replace tips over there with other economies. Yeah, that's it.
Okay. Oops. All right, I think that's a good discussion on these questions. Let's move on. Hi Boon Tee, you mentioned change your iPhone 11 battery. Can you share where you change your Apple outside? What is the consideration in choosing either? Okay, this one I didn't think a lot. I just went to the A Lab at Plaza Sing, and I know that it is expensive, but I think that time I probably have some voucher. I don't remember exactly. It was some time ago, so I just like I didn't think much. I won't, for some people who want to get the best deal, I won't recommend you to go to that shop. I think those are the one that's like like they have some arrangement with Apple, so consider the original one. But if you want to save some money, maybe you just go outside. I think that's fine. But in terms of the quality, I don't know. I think really you have to choose the one that you think best for you. Yeah, let's move on. When you change your iPhone 11 battery, how long does it take? Do the staff change in front of you or ask you to come back while they bring behind to change? I think it's on the same day, but you need to make appointment to make sure that they have a slots. If not, if you queue and then you are too late, I think probably they don't have enough time to change it for you. I need to wait some time now. I think maybe depending on maybe 30 minutes, 1 hour or slightly more, something like that. Yeah, but you don't have to like put your phone with them and then come back 2 days later. I don't think that is not I don't think that's needed. It should be on the same day, but it's not like a 5 minutes things lah. So just to prepare on that now. Okay, Elon Musk ebook, thanks. Unable to print out this EPUB. Is there PDF versions? For those who are not sure, okay, this one, even the PDF has been shared in the Telegram group. So I think if you are watching this from YouTube, there's a link to Telegram. You might join the group, and then it is in the group, so you can just grab it from there. Okay, next one. I saw your use Google Excel instead of Microsoft Excel. Okay, I think it's Google Sheets. Okay, I see Shopee there selling Microsoft 2021 keys for less than 20. Is there reason or risk you not buy those? Okay. Firstly, I think the good thing about Google Sheets is that everything is on the cloud. So sometimes I just want to, like get the informations while I'm outside. Then I can just use my phone to get it. So I think I do enjoy the the cloud services. But I know that Microsoft Excel also have the cloud versions, but I have not been doing that. On my PC, I have Microsoft Excel. So sometimes when I'm working on some more, like complicated calculations, I will use Microsoft Excel because Microsoft Excel is like a lot better compared to Google Sheets. But let's say if you just do some simple things, just need a spreadsheet to key in, store some data, do some simple calculations, I think Google Sheets is good enough. On your questions about Shopee selling 2021 keys for less than $20, this one I actually don't know. I don't know whether it works or not. What are the risks? I actually don't know. Anyone want to contribute on this?
Yeah, I did that. I bought the Shopee key. The only drawback is legal. The only drawback is that the email is already pre-registered, so you cannot use your own email. So if you have Microsoft Teams or use a lot of cloud share, you will find that there's some problems because then you have two different accounts: your own personal office account and the account that you bought $20 for. That's the drawback.
Okay, so it's not synced properly because you will have their account, right?
Yeah, right. That's the drawback. So, but if you're just using it for Office or Word, then it shouldn't be an issue.
Okay. That's interesting. And this one is not just the Microsoft Windows, right? It is the all the
Office.
PowerPoint, Excel, Word, right?
Yes, correct. I mean, it's in yeah, it's everything.
Okay.
I think it's office business. Office
All right.
business.
All right, I think that's good insights. I saw this $20 before, but I don't know like the details. I don't have experience buying this stuff. But thanks for sharing. Okay, I think next one also.
If you want to buy there's no need to buy Microsoft. I mean, no need to buy Windows key. If you are doing it for your own personal usage, and your own personal computer
Developer,
will never have a opportunity to do work with it, right? Then there's no need to buy a key. The whole Microsoft thing will work without the key. So only if you need to do work and you need to share like work account and things like that, then you buy the key and write it off as like a business expense. Otherwise, don't bother buying Windows at all. You can use the trial version forever, or there are other ways to just get like unlock the trial version. That's all.
Okay. Next one. The Microsoft keys, we still install software from Microsoft website. You just key in the key is correct, even if after 1 year cannot use, but still worth it. You want to comment on this? Typical Singaporean.
No, cannot. It's not. Yeah, you install software. The thing is that you key in the key. Actually, the keys are all generated algo, and they all connect with the server. So it's kind of like it's all server authenticated on the Microsoft side. So if you're doing it for work, it's best that you buy a legit key and use it for that, and also consider very clearly, because the most unworth it product is home. Whatever there is Windows Home is all not worth it. The minimum that you should get is Windows Pro, or the best is still Windows Enterprise, or whatever business portion that they have. Home is not worth it at all, because there's a lot of features that they disable on Home intentionally, or whatever the case it is. But I really don't like this pricing model at all, and it doesn't make any sense given that the way that they do things. Yeah. So if you are not getting any value if you buy Home. So basically, in terms of like how I would look at it, is that if you're going to get Home, you might as well don't get it at all. If you want to get minimum, get Pro or get Enterprise. That's it.
Okay, thanks for the comment. Let's move on. TCSS talk about C Limited. Can you guys have a discussion on C financial arm, which have high level of loan provisions and write-off as percentage of their loan book? This C financial arm seems like doing risky BNPL business. No one seems like talking about their big write-off on loans. Can TCSS have discussion and do one? So just curious, anyone look into this before in details? What about see other business, for example, their e-commerce? Anyone want to share here?
I mean, it works, but it's more or less stable business now already, because they don't have they're not expanding. So just look at their e-com. I mean, we'll see in the next quarterly report. Just the next 2 quarterly reports, we kind of see that their e-commerce is stable, and it becomes like a part of their business that is FCF generating already right now, stable, provided there's no competition or disruption. So that's the good thing that is going for it. As to all its other investments and other things into other arms, that one I really have no visibility on, and I also don't know exactly what their management is doing. Yeah, but their e-commerce is fine, it's good, and stable is stable. If you are not so sure about it, I would say just wait until the Q4 reports is out, and then you have 1 full year of data that is stable e-commerce.
Yeah, I think so. I think e-commerce, that's the thing about e-commerce, right? If they are not growing a lot, e-commerce is not let me mute. Typical Singaporean, you want to speak or what? Okay, mute already.
Yeah. The guy mentioned something about loan. They pay off. They basically write off a loan. I thought they provision the loan every year. I thought they provision.
I don't know. I don't know about
actually,
this loan
I never
provision
heard
and
of this.
write-off.
Yeah, I thought they just put a provision for bad payments lah. It's pretty standard, like 4%, assumption of 4% bad loans. Is that what the guy is talking about?
I guess so.
Yeah, I mean there's a pretty standard thing. I mean they basically have an actuary to determine it lah.
Okay, yeah, come back to this comment about e-commerce. I think e-commerce, if they're stable and not generating high growth, right? The problem is that their gaming business is like steadily going downhill. So I think their earnings will not able to grow if the e-commerce side is not going to grow. Like stable is just not enough for them because they have a segment that is profitable but sinking going smaller and smaller in scale. So that's my consideration. And I do observe that, for example, like Lazada, they are doing quite like they increase their promotions. I actually did some Lazada shopping, I think this month. Then I think that sometimes, if you are not spending money on growth and then your competitors are doing that, so I think that one will hit their growth further. So I think competition is part and parcel of this business and this sector. But I think that's the things you just need to see that their strategy, understand what they're trying to do. Because as of now, I really don't know what they are trying to do with the money banks on the financial arms and also their Shopee. Are they planning to grow into more markets, or let's say within the same market, what kind of strategy they have to like further expand their market shares, right? So all this I haven't been following a lot since I sold off my position. So I think that's my comment on this. No detailed analysis here. Anyone else want to share your view on C? Like what's your take? Comment?
Same as before. E-commerce is high capex and also high capex and low mode lah. That's what I think, because nowadays everyone can do e-commerce kind of things. The platforms, it's just a matter of gaining market share, and it's not really there's not really a lot of mode for e-commerce lah. Yeah, because the customers are already like used to it, because they know that in the end it's just about like signing up. And this e-commerce, you kind of like make your signing up process easy, so people sign up easily, and then you give promotions and people take it. If your whole entire process is not easy, right, then people don't sign up. So the thing is that the barrier to entry is no longer high, because anyone can just code it up and then just do it lor. So it becomes that the only barriers to entries that are really there is more on like how efficient you can cost optimize it, or speed optimize it. There's a mixture of that lah. And if you are the best at that, and you can lower your you can lower your operating you can increase your operating margin high enough, right, that your competitors can't come in, then whatever promotions that they do, they cannot come in at all lah. If let's say your operating margins are very thin, then the people can just take market share, and there's no way you can combat that. Yeah, that's the idea. So in a sense, it becomes like e-commerce is an oligopoly market structure, and the game is played in terms of like once everything is settled down, it becomes a cost efficiency operating margin game, and the capex is spent on defending that cost efficiency or defending the users from against other startups. That want to get into this area lor. So there's no technological mode at all. It becomes like a utility in that regard. And Yeah, yeah. It really becomes like a utility kind of business that yeah lor.
Yep, I totally agree on this. That's why Amazon's still doing fine because they are big into all these logistics, and ultimately the moat come from the scale. So and scale is not like just the e-commerce business is big. You really need the hardware, the logistics to support them. It's all about like, all these delivery network plus warehouses plus maybe, like some payment network, all these things combined together. So I think that those are much more important than just like a front, like a UI, right? So I think that's very important for e-commerce business. Okay, let's move on to next questions. In buying bonds that are long dated past 8 years and investment grade and above, how do you react to interest rate sentiment and actual interest rate hikes? So I think this one, although here is mentioned about like investment grade, right? I think to understand the interest rate sentiment and all these so-called interest rate hikes, right? You need to understand like in terms of the impact, right, you need to look at the yield curve, right? Because whatever Federal Reserve is doing, right, they are actually changing the overnight rate. So it's like almost like zero times zero, the rate here. So this is the only rate that is controlled by Federal Reserve. Hold on a second. But if you buy, let's say you buy either like a long-term bond, 10 years, 20 years, right? Or you buy into like ETF that holding long-term bonds, right? Like TLT, they hold those that is like longer than 20 years, right? What is driving the value of the bonds is actually the rate at this yield curve. So it is the 20 or 30-year rate that determine whether you enjoy a gain or losses. So that's why although if Fed keep on hiking interest rate, this short rate become higher. The long ends also tend to go up, but it is not one-to-one kind of correlations. It is possible that the short end increase, but the long end actually decrease. That's possible. That's why this is what we call the yield curve slope, right? The slope can be positive, can be flat, can be negative. So, but what is driving that is you want to pay attention to the long rate now. So that's something worth to point out because the question here is that let's say if you buy into long dated bonds, right? I think still come back to the questions of like whether inflation will come down or not. Because if inflation come down, the long term rate and the interest rate will come down, then you will have a realized gain, right? So basically, you need to pay attention to the entire yield curve, not just the interest rate hike or not. Because for those who focus on the short rate, right, like you say, hey, there's no Fed didn't announce any rate hike. How come your TLT drop in value, right? Because the 20-year rate can go up and down. So I think that's something to focus on. Then in terms of investment grade versus treasury, I think you are just taking additional risk in terms of the credit spread. But as long as it's investment grade, you will be okay. Like the spread usually they are quite stable unless we are getting into like big market crashes and then like COVID type of crashes, right? And big recession coming, right? So companies go bankrupt. Then some of these investment grade bonds they may downgraded or they may go default, right? So that one will hit into the returns as well. But let's say talking about like status quo, even a little bit of slowdown, companies doesn't go bankrupt, right? Investment grade is fine. You get that additional pickup in yield as compared to treasury, but you're actually taking slightly more risk as well. So this is talking about in corporate bonds here. Okay. Anyone want to add on this? Okay, if not, move on. YCX says don't need to buy latest iPhone. Really enlightenment. If in your shoe, would you buy you would buy which old iPhone now and from which shop? Offline only? Okay, YCX, you comment this one you seems to be more educated in terms of buying older iPhones.
I
Any
don't know,
recommendation?
man. Look at the spec sheet and see what are the features you want. No, I'm not buying any right now, so I don't go
Okay.
and look up on it. You know, if
Okay.
you don't need the camera to be so good, you're using your camera like once in a while only or whatever, then what's the point in buying such a good camera? Then
Yeah.
it's like if you never ever hit the storage maximum, then there's no point in buying a bigger storage either.
Yep.
That kind of that kind of basic things. The rest is just use only yellow, that's all.
Yep.
Of course, they all look the same.
Yeah, the look definitely. Yeah, same for me. But I'm not buying now. But if I'm going to buy one, right, I will just get the 15, the non-pro versions, because I think the pro one is like so like much more expensive, and there isn't like a features that I must have that features, right? So I think it's good just to get the non-pro versions. But usually how I save on money is I buy one, right? Then I use it for years, right? Because like I mentioned previously, I'm still using 11, probably use until next year. So you see from 11, use until the Apple launch maybe iPhone 16 or whatever, then only I upgrade now. So it is good for 3, 4, 5 years, right? So just continue to use it now. Okay, that's iPhone questions. Hi Boon Tee, thanks always for your effort. Just to feedback, this platform seems like the quota for words very little, but if there are no alternatives, then no problem. Yeah, I think I responded this actually. So this is Slido. So Slido, they have a limit, but you can type like bracket 1/2 just to help us know that this is like it will continue to another questions, right? So I can direct that. That's one way. The other way is that if you have any questions, come to Telegram group. Just ask your questions. There's so many people there to give their comments and opinions, right? And if you once like specifically want my opinion, then you can just tag my name, then I'll respond. Or if you don't want to be so public, you can just private message me. I will respond. Okay, so that's on this. C limited to how to spell this? To C limited to how now? Yeah, just now we talked about C limited already. I think I got nothing more to add here. But let's say, but coming to this, right? If like when you bought into the companies, you are betting on something, right? If you know why you are buying into that, and if the stock price getting lower, I think that's good for you, right? Unless you really don't know why you invest in this company at the first place. So I think that's why I say if the share price is down, right, it shouldn't be something that prompt you to have this emoji here, like a sad face here. But let's say if you say you bet on certain fundamentals to develop, right? You say you expect them to grow, you expect them to become more profitable. But if the fundamentals stall, then I think you become sad. Then I think that's fair lah, because all of us, when we buy into individual stocks, we have some like expectations. Sometimes it disappoint us. For example, I invested into TSMC. I tracked their fundamentals over the past few years. Also, actually, there's some disappointment. Like I overestimated their fundamentals, and I didn't see this like slowdown in smartphone business. I didn't expect it to be that serious. So fundamentals stall. But what can I do? I can bet hold. I can reduce my allocations, or I can double down, right? So it really depends on what's the new expectations taking into the new informations that we have, right? So I think that this one you need to continuously review your positions and see whether you want to pivot or double down. This is like portfolio management 101. So yep, I think that's on these questions. Anyone want to add on this? Okay, no. Move on. YCX, you read a lot. What is your usual sitting positions? Wow, this is the funniest questions that received so far. Any special chair or setup? How you protect your eye because sit and read a bit already tired. Want to learn from you. YCX, your comment?
No comment. Nothing special. Yeah, nothing special.
You
No
want to take a photo or not? Like put a camera and then teach us in terms of posture.
The normal sitting no different Just sit and read or whatever lah. Your work, you can read on the way to work or anything like that. So not who say must be always on the computer. In fact, most of the reading I spend is not on the computer. On computer is only when I'm free. That's all.
Yeah. Yeah, I think that's one thing I will highlight here. I think which is a good one is that you maybe exercise help here, because I think usually if you sit and you get tired, it's because the posture is bad. That's one thing. And the posture is bad because we don't have strong enough muscle to support the correct posture. Like it's more tiring to sit up straight, right? Because and then you will, if you don't have like your muscle is weak, it make it worse, right? So I think must do a bit of exercise also help here. I got nothing more to add here. Okay, let's move on. Where it says, will your brain think of other things when you read? Since like I read a bit, the brain keep think of this and that, cannot concentrate. Any advice? I think it come from the same person.
Nothing. I mean, if you think of other things and they are related, then just write it down or something. This, and then think more. That's all. Or yeah, think more. Or just take your time and do things. I mean, investment is a very slow thing. There's no rush. If you are rushing for things, that means it's not really an investment anymore. It's more of like you're playing some chart or something like that. But investment is slow. It's mostly you only see like some important events two to four times a year only. The rest is all very boring things that is fundamental based. Basically, whatever stock that you buy, it will always plus minus 15% thereabouts. If you can, yeah, thereabouts. You should not be worried at all if it plus minus 15% thereabouts. So if if it plus minus more than 15%, then there is something to be concerned about. Then you have to look and see what exactly changed. But when you allocate, because if your horizon is 2 years or more, and you are doing some kind of cost averaging allocation, then that is the point. That it shouldn't be, you shouldn't be lump summing into it, or even if you lump sum, it shouldn't be like lump sum all on one date. It really depends on how you allocate accordingly. I mean, take the time to actually figure out what you want to own, and then after you own it and you allocate to it already, just watch it happens. I mean, there's a reason why you buy that stock in the first place, right? It's not like you buy it and then after it goes up 20%, you think that I'm going to sell it. If that's the thing, then I mean, it works for you, then it works for you. If it doesn't, then I mean, there are many ways to make money. That's not the way it works for me. So yeah, that's all I can say.
Yep, good advice there. Yeah, I like the quote that investing is slow. Try not to do a lot. So I would say, like, if you have trades every week, right? I think that's too much already. Even every month, if you are doing DCA, that's fine. But if you in and out like every month, like your holding positions is shorter than a few weeks, right? I think that's too short. You need to slow down and then do less, think more, and just enjoy the the doing nothing part. I think this one take a bit of time to come up with the habits, so that you force yourself to think clearly into every position that you're entering or every position that you're adding to, or before you sell. Basically, before you do anything, just take time to go through the thinking process. I think that's not easy. Take time to practice. Hi, Boon Tee, can check with you if we buy electronic products online, is it dangerous as I see delivery staff or just throw the parcel around? How to avoid? Well, this one, I think, actually, even if you are not buying from e-commerce, right? Like you are buying from shop, right? You also don't know behind the scene whether that when they deliver to the store, is there any situation where they just throw around the stocks, right? So I think this one very hard to avoid one. But one thing I would say that for normal, typical electronics, say for example, like watches, as long as things that is without lenses, there's no glass, there's no lenses, right? I think still fine. Not a big issues. I think all these electronic stuff, they are not going to like just spoil because you throw around. But the other thing is that, let's say if you buy from reputable places and there's some warranty there, I think that one also give you some assurance that it will work fine. I would say don't worry too much. So far, either you open up, it's like really you need to send it for warranty, then you just send. If not, if it is usable, meaning that they are okay. Or despite maybe all these delivery men just throw around, throw the parcels, right? I think that's not a big issue. Anyone, YCX, you have any ideas you want to to solve this?
No, it's just buy when you see good reviews. Oh, that's about it.
But
There's
the
always reviews.
yeah, but the delivery stuff, I think that is also outside of the the merchant's control, right? But I would say usually they are fine one. Don't worry too much on this. Okay, next one. Boon Tee, refer to 100 Beggars by Chris Mayer, page 151. Warren Buffett on See Candies or Gold Oil. I know it's important. I read few times, don't understand. Can you give your view or understanding? Okay, I have to say sorry. I haven't really turned to page 151. I read this book before. But in terms of this specific page, I don't get it. If I have time to go through that, I'll give you a comment in the Telegram group. But I think the specific page aside, right? But I think this book about the 100 Beggars, right? I would say the key takeaway is that if you buy into a companies, just don't rush to like so-called take the profits. Because sometimes you buy into a companies, it shoot up by 20%, 50%. It's quite tempting to just sell. I think what Chris is advocating is that if you buy into a companies, if you really want 100 Beggars, meaning the price should go up by 100 times, right? They need at least like let's say 10 years or even more, right? Meaning that you need to hold on to the companies for a long period of times to get the 100 Beggars. Of course, during this period, if you pick like let's say 20 stocks, maybe 15, 18 of them like they don't have this kind of 100x returns, right? But you only need like one or two, right, to go up by 100x, then you will see a meaningful returns to your portfolio. I think basically that's it. We're not talking about like every companies that you pick will give you 100x. Some will actually lose money, some will go bankrupt, doesn't matter. But those that is like, if you pick the right one, they were able to compound over a long period of times, and 100x is possible. So this is the main thesis of the book. This one I'll come back to you on page 151. Okay, let's move on. How did you get your job in Singapore? I saw you work in KL first and then move it to Hong Kong based on your stories. Okay, I think the stories, right, I shared during one of the episode in Bagholder Pod. Okay, so I worked 2.5 years in KL, 1 year in Hong Kong, and then I moved to Singapore. In terms of how I get my job, I just go through headhunter. So basically go through recruiter. I think it's quite common, but this one you need to see. You need to go to the recruiter or headhunter that specialize in your profession, because they can't serve like all different markets, right? So there will be specialized recruiters. They hire specific talent or specific professionals into the companies. So that's the way to get into it. And then the other things I think maybe people don't take enough advantage of is that you need to build your own network around your people from the same industry, because unless you are like like fresh grads, right? If you already work for a few years, right, so you will know people in the industry, and when people look for like they're hiring, they will just ask around, right? So I think this one, especially for those that is like a niche sector or industry, you need to know people, so that whenever there's any job opportunities, they will pass around, they'll share around, and then that's the room, or that's the opportunity to get into the companies that you want to apply for now. So that's also something that I have done before. Okay, that's on that company. Thoughts on taking advantage of current high yield US Treasury bills. Me personally, I have been buying the T-bill ladders. Like I think Maximus also asked me a few times, right? Has it been completed or almost there? 6 months. Because I've been buying the 6-month T-bill, right? So I think the first one probably is about like 6 months ago. So almost complete there. But by T-bills, it doesn't meet the ladder doesn't need to be like like fixed amount, right? So sometimes I have more liquidity, I buy more, sometimes buy less. So it's not the like a flat kind of ladder, like it's like up and down, up and down. So I'm still building on these ladders lah. So I think it's quite useful to like getting, let's say, like 3.7% yield. At the same time, we are not concerned about the liquidity, right? Because if you want to wait for that 6 months, it's like quite far away. But let's say if you already have one that's maturing over the next months, then we are not so anxious, right? But I do think that let's say if you just started out, maybe put some money into money market funds also makes sense, because you can draw down from the money market funds anytime you like, right? So I think that's one also a good opportunity. The other one I want to point out is that for those who, like let's say if you swipe your credit card for at least $500 per month, right? And you have like 100K, then I think maybe just go for, like the UOB one account. I forgot the name, like UOB account. And you can get on average about like 5% yield if you have $100,000 to invest, because it's like the more you put in, I think you enjoy more interest rate. But then when you need to fulfill some criteria, for example, like you need to divert your salary payment to that account, and then and you need to swipe like $500 per month on the UOB cards. So I think that one also good for those who are into high yield saving deposit. Okay, that's on that one. See limited questions on the loan book or loan losses. I mean bagholders channel, which you all discussed see before on ad hoc basis. Mix up with TCSS. Okay, on this, I actually don't recall. Maybe Eric has mentioned about this, because aside from Eric, none of us have looked into C Limited in that details. But I will pass along these questions to Eric, and maybe depends on how whether he will respond or not. I'm not too sure. Maybe I will just share more if I get an answer from him. Okay. Next one. My IBKR account is Singapore. Is yours also Singapore? Is there any significant differences between IBKR Singapore and IBKR US? Okay, mine one, right, is really US. Because I set up my account before IBKR opened their account I set up their entity in Singapore. I think the differences, right, the one that I can recall is that the IBKR US, right, the one that I'm using, I can't buy Singapore stocks. If you are using IBKR Singapore, you can buy Singapore stocks. That's one. Secondly, maybe there are some small differences. For example, like the fee that you are paying, whether you need to pay GST on that or not. I think there might be some differences there. Aside from this, right, I don't recall if there's any big differences. For example, let's say if you do margin, I think margin rate also similar. In terms of the fee, also similar. I don't think there are other like big differences. I'm not sure like anyone else have compared this before. If you want to share your opinion, can share. Or yeah, if not, I really can't think of any others. So okay, that's it. Open to all. At the end of the road, what is you guys' expectation on bettering the S&P or any index funds you use as performance comparison in terms of percentage? Okay, I a bit lost here in terms of these questions. Basically, I think he's trying to ask like what is the better stock indexes to compare aside from S&P 500 lah. I think that's the questions, right? YCX or typical Singaporean, are you still there? Anyone you want to comment on this?
No law, just compare against yourself. Try to hit 15%, at least 15% or something. That's my point. I'm trying to hit at least 15% a year. That's all.
Okay, absolute return benchmark. That's interesting. Anyone else want to comment? Okay, if not, I'll say for this, right, if you are those who like, like very neutral in terms of geography, you think that, okay, S&P 500, because they only focus on US, you think that's not enough, you want a world one, I'll say just compare against VWRA. I think that's FTSE Global, right, which cover the entire world. I think that's something that you can look at. If you want to stick to MSCI, I think that's the MSCI ACWI. Also, is a world index. Okay. MSCI World is not world index. MSCI World is actually just the developed market index. Okay, so these are few indices that you can compare to. I won't say which one is the better one. Of course, there's the one that covering the whole world. There's the one that like S&P 500 is the popular one, but they only cover US, right? Or you can look at Nasdaq 100, which only cover, you know, like the top 100, usually tech companies, because they are listed on Nasdaq. So there are different index, depends on like actually depends on which universe that you want to cover. Like if you want to cover world, you cannot use S&P 500, right? So it's just like, you know, how you define your universe. Yeah, I would say for me personally, I'm comparing against S&P 500. I think that's just to keep it easy, because whether you want to plot a chart or whether you want to, you know, do a simple comparison, I think S&P 500, there's just more data available. I think that's a good thing about S&P also. Yeah, in terms of expectations, I would say like nothing much. I think I've shared this a lot. If you invest in diversified equities, you should be expecting between 4 to 6% equity risk premium. By equity risk premium, that's the additional return that you get on top of you know, like fixed income. So that's the benchmark lah. Okay, but I think absolute benchmark, like what YCX shared, right, like 15%. I think that to me 15%, okay, given the kind of active investment that YCX doing, right, I think that makes sense, given that you spend so much time and do this kind of like concentrated active picking. I think 15% sounds fair. But let's say if you just invest in, you know, like diversify and then follow all this S&P ETF, I don't think you can get 15%, because 4 to 6% risk premium plus risk-free rate between, let's call it like 3 to 4%, right? We are talking about like about 8% per year. That's the broad market returns. Okay, the next one, how do we start to invest? I think it's a bit vague on these questions, because we don't know about your details, whether you are still studying, whether you just graduated, or whether you are already at, you know, like 40 years old, 50 years old, but just started investing. So this one, if we don't have enough you know, background details, is a lot harder to give any comment. But let's say if you say start, right, and I just assume that you're just graduated, just starting working, have some savings. I would say go for the easier one, meaning that maybe just get into those like, you know, VWRA ETF, or even if you have like set up your Mumu Tiger account and you don't have access to all these UCITS ETF, right? Even just buying SPY, also okay. I think you basically you just need to get started lah. And then if you are just starting, I would say focus more on the habit lah. How to develop a good habit for investing. That one is a lot more important as compared to like buying the best ETF, because there's no such thing as the best ETF, right? Each of them have their pro and con, and it will take a bit of time to you know, come up with a strategy that you think is okay to just stick to it for, you know, 10-20 years. The maybe the first 3 or 5 years, probably you are just trying around. That's why I say focus on develop the habit, specifically the habit of like, you know, like DCA, like dollar cost averaging. Don't pay too much attention to all these, you know, market noises. All these take time to practice. So yeah, I'll say, yeah, that's how to start. Even for myself, right, I started out my IBKR portfolio in 2017. It's not like I've been doing the same thing since I started, right? Actually, I started out buying, you know, all these like VOO, VWO ETF, and then only I learned about like all these, you know, UCITS ETF give a much better tax treatment, and also estate tax. So suddenly this thing become important, and I learned along the way. Then I just ship out, right? So whatever that you're doing, right? Say for example, you start out with SPY. It's not, doesn't matter. You just need to continuously invest, and as soon as you find another better strategy, right, you can just move on, right? You can just steer around, steer your portfolio to something that's better, right? So no need to pick the, you know, the best things right from the start. I would say just pick the easier one first, and then just you know, like take your time to do your research and then find something that is like meet your risk profile, and then something that you are comfortable with, and continue to steer. So yeah, it is a journey. It's not like something that you start out then you found your best solution already. That's not the way to go. Okay. Yeah, I think I think we have the discussion is a bit long because we have some debate at the beginning, which I think also useful to have this kind of like some debate here and there. And this round we have YCX, we have typical Singaporean. Thanks a lot to two of you for helping answering the questions. Thanks a lot for joining. I'll post the recording later. Thank you so much. I'll end the call here. Bye bye.